Here is a question that should have a simple answer, but most Canadians get completely wrong. If you invest $10,000 today at a 10% annual return and never touch it, how much is it worth in 30 years? Most people guess somewhere between $30,000 and $50,000, maybe $80,000 if they're optimistic. The real answer is $174,494. Not because of luck, not because of any special strategy, just because of one mathematical principle. Compound interest, working quietly for 30 years. And here's the number that should genuinely bother you. Knowledge and understanding of mathematical concepts related to finance is quite low in Canada, with only 26% of respondents showing a basic understanding of the impact of inflation, and high numbers reporting they do not know the answers for questions about simple and compound interest, according to the Financial Consumer Agency of Canada. Only 26% of Canadians understand the basic mathematics of compound interest, the single most powerful wealth-building concept in personal finance. And 3/4 of the country doesn't understand how it works. This video changes that. By the end of it, you'll understand exactly how compound interest works, why the S&P 500's 99-year history makes it the most reliable compounding vehicle ever created, why a 10-year delay costs you not just 10 years of returns, but potentially hundreds of thousands of dollars, and the one decision that determines whether this force works for you or against you. Let's forget textbook definitions. Here's all you actually need to know. Simple interest earns returns only on what you originally invested. You put in $1,000 at 10% simple interest. You earn $100 every year, year after year. The same $100. It doesn't grow. Compound interest earns returns on your original investment and on every dollar of growth you've already accumulated. You put in $1,000 at 10% compound interest. Year 1, you earn $100. Total, $1,100. Year 2, you earn 10% on $1,100. That's $110. Total, $1,210. Year 3, you earn 10% on $1,210. That's $121. Total, $1,331. Notice what's happening. The amount you earn each year keeps growing. Not because you added anything, but because your earnings became part of the base that earns more earnings. That's the entire concept. Your money makes money, and then that money makes more money. Over short periods, it looks unremarkable. Over long periods, it becomes something that feels almost impossible. Here's the proof. Since 1928, the S&P 500 has produced a nominal compounded annual return of 9.94%, meaning $100 invested in 1928 would be worth $982,920 today. A total return of 982,820% from a single $100 investment. That is not a mistake. $100 in 1928. Nearly $1 million today. From one investment that was never touched. At a 10.3% annual return, the S&P 500's annualized total return since 1957, a 10.3% annual return can turn $10,000 into over $189,000 over 30 years. The math isn't complicated. The patience is. Your action step. Take your current savings balance. Multiply it by 1.08 to see what it becomes in 1 year at 8%. Then multiply that result by 1.08 again. Do it 10 times. That number, after 10 simple multiplications, is what you'll have in a decade at 8%. Most people have never done this calculation. Once you do, You won't look at savings the same way again. Here is where the math stops being academic and starts being personal. Most Canadians say the same thing. I'll start investing when I have more money, when things settle down, when I pay off some debt first, when I'm ready. That delay, even by just 10 years, is one of the most costly financial decisions a person can make, and the numbers prove it in a way that is impossible to argue with. Meet Jordan and Alex, two Canadians, same income, same job, same city. Jordan starts investing $500 a month at age 22 in a low-cost S&P 500 ETF. At a conservative 8% annual return, Jordan invests for 43 years until age 65. Alex waits. At age 32, just 10 years later, Alex starts investing the same $500 a month at the same 8% return, investing for 33 years until age 65. At age 65, Jordan ends up with $1,130,000 more than Alex. Not from earning more, not from investing more per month, not from taking more risk, from starting 10 years earlier. And here's the number that makes this truly visceral. The extra $1,130,000, Jordan ends up with cost only $60,000 more in contributions. The 10 years of $500 per month payments Alex skipped. $60,000 in extra contributions produced $1,130,000 in extra wealth. That is the power of time in the compounding equation. Stocks have finished positive in 71 out of the last 97 years, 73% of the time, since 1928. The long-run direction of the market has been upward for nearly a century. Waiting for the right time to start is, statistically, the wrong strategy. Your action step: calculate what your portfolio would be worth today if you had started investing 5 years ago with whatever amount you currently have available. That number, the one that doesn't exist because you waited, is the real cost of delay. Here's a piece of math so simple you can do it in your head, and it will change how you think about every financial decision you make from this point forward. It's called the Rule of 72. Divide 72 by your annual return rate, and you get the number of years it takes your money to double. That's it. One division, instant clarity. Here's what it looks like across different return rates. Savings account at 2% takes 36 years to double. Conservative S&P 500 estimate at 8% takes 9 years. Credit card debt at 20.99% takes just 3.4 years, and your debt doubles. Now apply this to a real Canadian TFSA scenario. You invest $25,000 in a low-cost S&P 500 ETF at age 25. The S&P 500 has returned 10.3% annually since 1957, according to Motley Fool's 2026 data. At 10%, doubling every 7.2 years, one $25,000 investment at age 25, never touched, never added to, becomes over $1 million by retirement. That is the Rule of 72 across a lifetime. 5 doublings. From a single contribution that fit within a single year's TFSA room. And inside a TFSA, all of that growth is completely tax-free. The CRA takes nothing from any of those doublings. The entire $1.1 million is yours. Your action step: apply the Rule of 72 to your own situation right now. Take your current savings or investment balance and calculate how old you'll be when it doubles at your current return rate. Then calculate how old you'll be when it doubles again. That timeline, those future ages, makes compounding concrete and personal. Compound interest is the most powerful wealth-building force available to any Canadian. Here are the 3 things that destroy it, and each one is quietly at work in most Canadian households right now. Killer 1. High fees. Low-cost S&P 500 index funds keep fee drag minimal. VOO and IVV currently charge 0.03% annually, while FXAIX charges 0.015%. An actively managed fund charging 0.75% to 1.0% creates a compounding drag that, over 30 years, can translate to enormous differences in final wealth. The average Canadian bank mutual fund charges a management expense ratio of 2.0% to 2.5% per year. A low-cost S&P 500 ETF charges 0.09% to 0.20%. On a $200,000 portfolio over 30 years, the difference between 2.0% MER and 0.20% MER is over $858,000 in lost wealth. Fees don't just cost you the fee. They cost you every dollar of compounding that fee would have generated. Forever. Killer 2. Selling during market downturns. The S&P 500 returned minus 19.44% in 2022. Many investors panicked and sold. The S&P 500 then returned plus 24.23% in 2023 and plus 23.31% in 2024. According to Macro Trends historical data, the investors who sold in 2022 missed two of the best consecutive years in recent memory. The investors who stayed invested, who let compound interest work through the discomfort, came out dramatically ahead. Over the 50 years from 1975 to 2024, the S&P 500 produced an average annual return of 10.6%, a median return of 13.1%, and a standard deviation of 16%. The volatility is real. The long-term direction is also real. Selling during volatility is how investors permanently underperform. Killer 3. Starting in cash instead of equities. The national household saving rate has fallen to historically modest levels, around 4% to 5%, and household credit market debt in Canada exceeded $3 trillion in 2025, with a household debt-to-disposable income ratio hovering around 172% to 174%. The Canadians saving 4% to 5%, who hold that savings in a bank account earning 1% to 2%, are experiencing negative real returns, their savings losing purchasing power every year to inflation. Compound interest requires a return above inflation to build real wealth. Cash in a standard savings account in an inflationary environment is not compounding. It is eroding. Your action step: check your current investment fees. If you hold bank mutual funds, look up the MER today. If it's above 0.5%, calculate the 30-year difference between your current fee and 0.20%. That number is what moving to a low-cost ETF is worth. Here is the one decision the hook promised. And it's simpler than you expect. Every financial outcome this video has described. The $2,023,000 from $500 per month. The $174,494 from a single $10,000 contribution. The $1.1 million from one $25,000 TFSA contribution. Shares exactly one variable. They all start. That's it. The one decision. Starting. Not the perfect amount. Not the perfect time. Not the perfect market conditions. The decision to begin, and to automate that beginning so it never requires the decision again. Here's what that looks like in practice for any Canadian in 2026. The minimum viable starting point. Open a TFSA at Wealthsimple Trade or Questrade. Free, online, takes 10 minutes. Buy one low-cost S&P 500 ETF inside it. XEQT or VEQT for global diversification at 0.20% MER, or a pure S&P 500 ETF at 0.09%. Set up an automatic monthly contribution, whatever your budget allows. $100, $200, $500. The amount matters less than the automation. Enable DRIP, automatic dividend reinvestment. So every dividend payment buys more units without any action from you. Never sell during downturns. Never check the balance monthly. Check it quarterly at most. That is the entire system. 5 steps. 1 afternoon to set up. Decades to compound. Here is what different starting amounts produce at 8% annual return over 30 years inside a TFSA. Look at the $100 per month row. $36,000 total invested over 30 years. Portfolio value, $149,035. $36,000 in. $149,035 out. Tax-free. From $100 per month. Less than most Canadians spend on coffee. Only 35% of Canadians sought financial advice in the past 12 months, with friends and family being the most popular source of advice, followed by banks and investment firms, according to the Financial Consumer Agency of Canada's 2025 survey of nearly 8,000 Canadians. 65% of Canadians are navigating their financial future without any professional guidance, and with only 26% understanding compound interest. This video is the guidance most Canadians never get. The one decision isn't about being wealthy. It isn't about timing the market. It isn't about picking the right stocks. It is simply deciding that compound interest will work for you, starting today, instead of working against you in credit card debt and a weak savings rate forever. Your action step: open your TFSA this week if you haven't. Set up a $100 automatic monthly purchase. That's it. The system runs itself from there. Let's come back to where we started. $10,000 invested at 10% annual return for 30 years. Most people guessed $30,000 to $50,000. The real answer was $174,494. But here's the part of that answer we didn't mention at the start. If that same $10,000 sits in a Canadian TFSA, it grows to $174,494, and every single dollar of that gain is completely tax-free. The CRA takes nothing. $164,494 in pure compound growth belongs entirely to you. Now add $500 per month for those same 30 years. Total invested, $190,000. Portfolio value, $881,000. Tax-free. That's not a fantasy. That's the S&P 500's 99-year track record. 9.94% nominal compounded annual return since 1928, turning $100 into $982,920 over that span. Applied to a regular Canadian's regular monthly contribution inside a registered account that the government created specifically for this purpose. Only 26% of Canadians understand compound interest. The average Canadian household savings rate is 4% to 5%. Household credit market debt in Canada exceeded $3 trillion in 2025, with a household debt-to-disposable income ratio of 172% to 174%. These numbers paint a picture of a country where most people are working against compound interest instead of with it, paying 20.99% on credit card debt while saving 4% in cash. The math doesn't care about any of that. It just works, in whichever direction you point it. Point it forward. Start today.